For years, California's rental market looked unstoppable prices, soared demand outpaced supply, and tenants fought for apartments like lottery tickets. But as 2025 unfolds, that golden run is cracking. Across the state, for rent signs are multiplying, vacancy rates are rising to decade highs, and for the first time in years, it's the landlords who are sweating. According to Zillow and Redfin, statewide rents have fallen by roughly 6% this year, with several major cities seeing double-digit declines. Luxury towers that once filled overnight are now offering free months of rent move-in bonuses and flexible leases just to keep tenants interested. It's a shocking reversal for a market that once defined scarcity and success. What changed? A perfect storm: years of overbuilding during the pandemic boom, shrinking migration into the state, and sky-high insurance and utility costs that have made living in California harder than ever. Remote work gave people freedom, and many never came back. Today on Discover the Nation, we're breaking down the top 10 California cities where the rental market is crashing fastest in 2025, from coastal paradises to inland strongholds, where numbers tell the story of a new reality. Stay with us. By the end of this video, you'll know exactly which cities are falling fastest and why the California rental market crash 2025 may only be the beginning of a deeper reset in the California housing trends shaping the next decade. Number 10. Santa Clarita. Paradise. Not anymore. Just 30 miles north of downtown Los Angeles, Santa Clarita was once the picture-perfect suburbs: spotless streets, top-rated schools, and a promise of family stability. But in 2025, that dream is quietly unraveling. Vacancy rates have climbed to 7.8%, the highest in nearly a decade. Median rent for a two-bedroom apartment, which once topped $2,900, now averages around $2,250, and landlords are still cutting prices each month just to stay competitive. What went wrong? During the pandemic boom, developers built aggressively across Valencia and Canyon Country, betting that the migration from Los Angeles would never slow. But as remote work faded and companies called employees back to offices, the demand that fueled that expansion evaporated. Rows of shiny new apartment complexes now sit half-occupied, their leasing banners fading under the relentless California sun. Utility costs are up nearly 20% year-over-year, insurance premiums have soared, and commuting into the LA basin, once the trade-off for suburban peace, now drains both time and wallets. Even longtime residents are packing up, heading east to more affordable inland cities or out of state entirely. The balance of power has flipped. For the first time in years, renters hold the leverage. Landlords are offering incentives, waived deposits, and flexible leases, deals that would have been laughed at 2 years ago. Santa Clarita hasn't lost its charm, but its housing equation no longer adds up. The city that once symbolized suburban perfection now stands as an early warning for California's broader reset, proof that even the most stable markets can stumble when optimism outpaces reality. Number 9. Sacramento. California's capital city once symbolized opportunity, the affordable escape from the Bay Area's suffocating rent crisis. Between 2020 and 2022, tens of thousands of remote workers flooded in, pushing rents up more than 40% in just 3 years. Downtown cranes dotted the skyline, luxury towers rose along R Street, and investors called Sacramento the next big thing. But in 2025, that optimism has vanished. Vacancy rates have surged to 9.2%, and average rents are down 7% year over year. The same high-rise apartments that once had waiting lists now offer free rent for 60 days and move-in bonuses just to fill units. What caused the slide? Developers built like the boom would never end. Billions poured into high-end apartment complexes designed for remote tech workers and Bay Area transplants. But those tenants didn't stay. As companies brought employees back to the office, or as workers left California altogether for cheaper metros like Boise and Austin, the demand that fueled Sacramento's rise disappeared almost overnight. Even local households are feeling the strain. Property taxes are higher, utilities are eating into monthly budgets, and inflation has chipped away at disposable income. Downtown feels quieter, offices half full, and the once thriving nightlife has dimmed. Still, this isn't a collapse, it's a reset. Sacramento remains livable and vibrant, but the imbalance between supply and demand is forcing prices back toward reality. For investors who bought during the fever pitch of 2022, though it feels like freefall, the lesson? Even safe secondary markets can stumble when overconfidence replaces fundamentals. Number 8. Long Beach. For decades, Long Beach was Los Angeles County's quiet coastal success story, ocean views, without Malibu prices, and a community that blended beach life with city convenience. But in 2025, that story has taken a sharp turn. Vacancy rates have climbed to nearly 10%, the highest since the aftermath of the Great Recession. Median rent for a two-bedroom apartment has dropped from $2,750 in 2023 to around $2,400 today. And the incentives tell the story: 2 months free and no deposit banners now hang from buildings that once had months-long waiting lists. What happened? During the pandemic boom, developers lined the skyline with cranes, betting that demand for coastal apartments would never fade. But when companies started calling workers back to the office, hybrid employees abandoned the coast to move closer to job hubs or out of California altogether. Meanwhile, operating costs have soared. Property insurance premiums are up more than 20%, utilities keep climbing, and local rent control policies have squeezed smaller landlords out of the market. The result is a paradox: too many empty luxury units, yet still not enough affordable housing. Walk along Ocean Boulevard or through Belmont Shore, and you'll see the signs quieter, streets, storefronts changing hands, for rent banners that linger for weeks. What was once the middle-class answer to Southern California's housing crisis is now part of its reckoning. Trade-off. The city's coastal charm remains, but affordability has vanished, and landlords are struggling to adjust to a tenant-driven market. Would you still rent here at $2,400 a month, knowing that incentives are everywhere and prices are still sliding? Number 7. Oakland. For years, Oakland stood as the Bay Area's working-class alternative, gritty, diverse, resilient, and full of opportunity. But in 2025, the city, once seen as a refuge from San Francisco's prices, is now leading the region's rental collapse. Vacancy rates have surged past 10.5%, while average rents have dropped 11% year over year. Luxury towers that once filled with tech commuters now sit half empty, their lobby lights glowing over vacant hallways. What triggered the downturn? It started with the tech layoffs of 2023. Thousands of employees who once fled San Francisco's high costs suddenly left the region altogether. Remote work and hybrid schedules emptied offices, and safety concerns pushed even more residents to move out. The downtown core, once buzzing with cafes and nightlife, now feels subdued, a shadow of its pre-pandemic energy. Landlords are slashing rents by hundreds of dollars a month. Some offer free rent for the first quarter, others throw in parking or gym memberships. But even with concessions, demand isn't catching up. Longtime renters are renegotiating leases, knowing they finally have leverage. Meanwhile, small property owners are feeling the squeeze: rising maintenance costs, higher property taxes, and thinner margins. Many are selling units at a loss. For investors who once saw Oakland as the value play of the Bay, the sentiment has shifted from optimism to uncertainty. Locals describe it as a confidence collapse. The city's pride and resilience has met its breaking point, and recovery will take time. Yet beneath the slowdown, there's still grit, community markets, art, and activism, keeping the soul alive even as the numbers fall. Oakland's correction isn't just financial. It's psychological, a reminder that no city, not even the heart of the East Bay, is immune to gravity. Number 6. Los Angeles. For decades, Los Angeles seemed immune to downturns. With its unbeatable mix of entertainment, tech, and sunshine, demand always felt endless until now. In 2025, even the City of Angels is coming back down to earth. Rental prices across LA County have fallen about 8% year over year, marking the steepest drop since the Great Recession. Vacancy rates have climbed above 7%, and in some neighborhoods that figure has doubled. The reason? Outmigration. Since 2020, more than 200,000 residents have left Los Angeles County, lured by lower costs in Nevada, Arizona, and Texas. The pandemic's remote work boom gave people freedom, and once they left, many never returned. Developers, meanwhile, didn't stop building. Convinced that LA's allure would keep every high-rise full, they poured money into towers across Koreatown, Hollywood, and Culver City. Now those same towers are offering steep discounts, free parking, and waived deposits to fill units that once rented within hours. Even LA's once untouchable West Side isn't immune. Studios that went for $3,500 a month are sitting empty at $2,800 with incentives attached. Mid-tier neighborhoods like North Hollywood and Echo Park tell a similar story. Open houses that used to attract crowds now see barely a handful of renters. Property insurance is up, utilities are rising, and inflation has stretched working-class Angelenos to their limit. The city isn't collapsing, it's resetting. For renters, that's long overdue relief. For landlords, it's a rude awakening. The glitz is still there, the palm trees, the sunsets, the ambition, but the numbers no longer match the fantasy. For the first time in over a decade, renters hold the upper hand. Number 5. San Diego. Few cities capture California's dream quite like San Diego Golden Beach's perfect weather and a reputation for endless demand. For years, it was considered recession-proof, but in 2025, even paradise is cooling. Across San Diego County, rents have fallen 7% over the past year, while vacancy rates have climbed beyond 8%, the highest level since 2010. Once red-hot neighborhoods like Pacific Beach, Little Italy, and Hillcrest are all losing momentum. What's behind the shift? Developers spent the last 5 years flooding the skyline with luxury apartments, banking on high-income tenants from biotech, defense, and remote tech jobs. But rising interest rates, record insurance premiums, and electricity costs among the highest in the state have pushed many renters out. Leasing offices that once had waiting lists now sit quiet. Managers are offering rent credits, flexible leases, and move-in perks just to stay afloat. Even professionals earning six figures are choosing inland cities like Riverside, Temecula, or Murrieta, where rent is hundreds cheaper and commutes are shorter. Downtown towers with unlit floors, half-empty parking garages, and now leasing signs hanging where sold out once stood. But let's be clear, San Diego isn't collapsing, it's rebalancing. After a decade of relentless rent hikes, the market is finally catching its breath. Property owners who over-leveraged during the boom are feeling the pinch. But for renters, this is long-awaited relief. Even longtime homeowners are noticing the ripple effects: slower property appreciation, fewer bidding wars, and a sense that the city's housing euphoria has finally cooled. San Diego's message to California is simple: even paradise must answer to math. Number 4. San Francisco. No city embodies California's housing highs and lows quite like San Francisco, once the epicenter of innovation, wealth, and impossible rents. But in 2025, that same city now stands at the center of its deepest rental decline in a generation. Vacancy rates have soared past 11%, an unthinkable number just a decade ago. The median rent for a one-bedroom apartment has fallen from $3,750 to about $3,200, with some luxury units now renting for less than they did in 2015. So what caused the fall? A perfect storm of remote work tech layoffs and a flood of new inventory. When thousands of workers stopped commuting into downtown, demand for rentals collapsed. Developers tried to adapt by converting empty office buildings into residential spaces, but those conversions only added to the oversupply. Today, entire districts like Soma and Civic Center tell the same story: sleek towers with sweeping skyline views, half dark at night. Iconic buildings like Nema and 181 Fremont, once symbols of exclusivity, now advertise rent incentives and flexible leases. But the pain runs deeper than numbers. San Francisco's identity has always been built on momentum, on the belief that innovation would outpace risk. Now that confidence feels fragile, and yet under the surface there's opportunity. For the first time in years, middle-income renters can afford to live in neighborhoods like Hayes Valley or Mission Bay. What was once fantasy is now possible again. This isn't the end of San Francisco, it's an evolution. The boomtown has hit bottom, but from here it can reinvent itself just as it always has. Number 3, Riverside. For years, Riverside was California's safety valve, the place families fled to when coastal rents became unbearable. A spacious home, a driveway and sunshine without the staggering price tag. But in 2025, even the Inland Empire's stronghold is showing deep cracks. Vacancy rates have jumped to 9.4%, and average rents are down nearly 10% year over year. What went wrong? Overbuilding and overconfidence. During the pandemic, developers rushed to meet the tidal wave of migration from Los Angeles, convinced that remote work would make Riverside a permanent magnet. Entire neighborhoods in Moreno Valley and Eastvale were transformed with shiny new apartment complexes. But population growth has stalled. Remote work is fading job markets in logistics and warehousing. The backbone of Riverside's economy have softened, and Amazon's decision to scale back local expansion cut thousands of jobs. The ripple effects hit renters first. The irony, housing here is still cheaper on paper, but when you factor in skyrocketing insurance, energy bills, and commuting costs, many households find it just as unaffordable as the coast. Property owners, meanwhile, are scrambling to fill units offering waived application fees, free parking, and 1 or 2 months of rent discounts. Drive through downtown or along the 91 freeway and you'll see it. Now leasing banners, half-empty lots, and pools shimmering silently in the midday heat. The bigger message, Riverside's decline, is less about panic and more about perspective. The city, once seen as the solution to California's housing crisis, is now learning that no market, not even the affordable ones, can escape oversupply. Even in the Inland Empire, the foundation can crack when optimism builds faster than reality. Number 2, San Jose. For decades, San Jose stood untouchable, the gleaming heart of Silicon Valley home to billion-dollar startups, 6-figure salaries, and rents higher than almost anywhere outside Manhattan. But in 2025, even the tech capital of the world is learning what gravity feels like. Median rent in San Jose has fallen 12% year over year, while vacancy rates have surged above 10% levels not seen in more than 20 years. The reversal is historic. What caused it? The same tech industry that built San Jose's economy has now pulled the rug out from under it. Layoffs at giants like Google, Meta, and PayPal have emptied thousands of high-income apartments. Meanwhile, remote work, once hailed as a permanent perk, has freed employees from the Bay Area's punishing costs. Many are heading to cheaper innovation hubs like Austin, Denver, or Salt Lake City. The fallout is visible everywhere. Downtown's sleek towers built during the 2017 to 2021 construction boom are half empty. Rooftop lounges sit unused, co-working spaces echo with silence. And even in the suburbs of Cupertino, Mountain View, and Sunnyvale, for rent signs are multiplying. Developers are slashing prices, luxury complexes in Santa Clara, and Certino are quietly lowering rents by $400 to $700 a month. For landlords who believed Silicon Valley demand could never fall, the shock has been profound. But for renters, this is long overdue relief. Engineers, families, and students who once paid $4,000 for modest apartments are finally seeing breathing room. The power dynamic has flipped, landlords are negotiating again, and tenants are calling the shots. San Jose's downturn isn't just a market correction, it's a symbol. The region that built the future is now confronting its own limits, a reminder that no economy, no matter how advanced, can outcode reality. Number 1, Bakersfield. At the top of our list, and perhaps the most surprising of all, stands Bakersfield, California's longtime affordability anchor. For years, this working-class city was the final refuge for families priced out of Los Angeles, Fresno, and the coast. But in 2025, even Bakersfield is facing a rental storm that few thought possible. Vacancy rates have exploded past 12%, the highest in the entire state, and rents have plunged by 13% year over year. For a market that once symbolized stability, the downturn is nothing short of staggering. During the pandemic, developers rushed to build thousands of new apartments, convinced that migration from the coast would never slow. But when the economy cooled and population growth stalled, demand evaporated. Local pain runs deeper than construction missteps. Bakersfield's economy relies heavily on agriculture, logistics, and oil, three sectors hit hard in recent years. Drought automation and global price pressures have cut agricultural jobs, while slower logistics demand and oil market volatility have reduced employment opportunities. With fewer jobs and rising household expenses, many renters are packing up and leaving altogether. Shopping centers quieter than they've been in years, neighborhoods dotted with for rent signs, and landlords slashing prices to stay solvent. Those who bought investment properties at the peak are underwater, and smaller owners are struggling to make ends meet. Yet amid the pain lies something transformative, a true market reset. For the first time in over a decade, Bakersfield's housing is genuinely affordable again for working-class families. But the symbolism is powerful. If even Bakersfield, the city, once immune to California's volatility, is struggling with oversupply and falling rents, then the California rental market crash 2025 isn't coming. It's already here. From Santa Clarita's fading banners to Bakersfield's empty complexes, the signs are everywhere. California's rental market is no longer untouchable. The year 2025 has marked a true turning point. Vacancy rates are climbing, incentives are back, and the once unstoppable landlord market is finally slowing to a crawl. First, interest rates remain stubbornly high, freezing investor confidence and slowing new construction. Second, insurance and utility costs have ballooned, squeezing landlords' margins and making profitability harder to sustain. And third, overbuilding during the pandemic boom has left cities with more units than tenants, from Silicon Valley's glass towers to the suburbs of the Inland Empire. Together, these forces have flipped California's long-standing housing hierarchy. For the first time in years, renters have leveraged the freedom to negotiate, to choose, and to walk away. Landlords are adjusting, developers are recalculating, and the state itself is rediscovering what balance feels like. Still, this isn't a collapse, it's a reset. Markets are cooling, not crashing. Opportunities are shifting, not disappearing. The California rental market crash 2025 may sting in the short term, but in the long run, it's clearing the excesses that built up over a decade of unchecked growth. The California housing trends of 2025 tell a simple truth: even golden markets must obey gravity. Question for you: which city shocked you the most? San Francisco's fall or Bakersfield's plunge? And if this breakdown opened your eyes, hit subscribe and stay tuned, because we'll keep following every twist in the California rental market crash and the California housing trends that will define the decade ahead. Ting developers are recalculating, and the state itself is rediscovering what balance feels like. Still, this isn't a collapse. It's a reset. Markets are cooling, not crashing. Opportunities are shifting, not disappearing. The California rental market crash 2025 may sting in the short term, but in the long run, it's clearing the excesses that built up over a decade of unchecked growth. The California housing trends of 2025 tell a simple truth: even golden markets must obey gravity. Question for you: which city shocked you the most? San Francisco's fall or Bakersfield's plunge? And if this breakdown opened